Hey everybody, Larry Berman here. Happy St. Patty's Day. Really interesting times in the markets. I mean, in general, there's always a great story. There's always something, exciting happening. Obviously, the last couple of weeks has really, focus has been on the banks and the rapid speed of Fed rate increases and what it means for markets. And I got a couple charts to show you this week, so let's dig right in and see what we learned. Our first chart here is the volatility index of the bond market. So this looks at the 10-year bond, probably a broader basket of fixed income securities, and looks at the implied volatility. So this is the VIX of the bond market. And we can see in this past couple of weeks the really sharp move up here in terms of bond volatility. It's literally doubled in the last week and a bit. We've gone higher in terms of bond volatility than we saw during COVID, and we're back at levels not seen since the depths of the financial crisis in 08 and 09. And so that is incredibly meaningful. When you look at the same perspective from the VIX, we saw obviously a massive move in vol on COVID for equities that was equivalent to what we saw during the GFC, where we compared to where we are now. So why is the bond market volatility so much more extreme than what we're seeing in terms of the equity market, and which one is right about anxiety and which one is wrong? Well, if we look at Fed funds futures contracts or OIS in terms of what's priced in to the bond curve, we don't have a full rate hike priced in. So the meeting this week, FOMC on the 22nd, 60% chance that they raise rates 25 basis points. A week ago, just before Silicon Valley Bank blew up and the Fed was giving his hawkish talk to Congress, we were expecting almost fully 50 basis points priced in terms of rate hikes this week. So obviously what's happened there has dramatically changed the higher for longer message from the market's perspective. We will see this week what happens. Now, Christine Lagarde, when the ECB raised rates 50 basis points this week, was clear that the current news, whether that's Credit Suisse for them or what's happening domestically in North America, but really in the US and the regional banks. That aspect is a huge factor. We are now pricing in, by the end of the year, 3 full rate cuts. So never mind a hike, but 3 full rate cuts. And if we do get a hike, that would imply 4 rate cuts by the end of the year. So why would the Fed raise rates? I think they're going to raise rates 25. I don't think they should. And a lot of the talking heads this week, that was a general view where they're probably going to raise rates. They're going to give a bit of a we're still there fighting inflation narrative, but at the same time, we're data dependent. So if this really does cause a major credit contraction where banks are lending less and therefore a shrinking and almost certainty of a recession, then pricing in the rate cuts makes sense from a market perspective, but only if inflation pressures come down pretty dramatically in the months to come. And that's really going to be the wait and see, the data dependency, the message from the Fed this week. So it will be really interesting to see how all that plays out. When we look at the divergences, and so, if inflation's coming down, then duration i.e. companies that don't pay dividends versus companies that do the more value-oriented plays, i.e. the banks. We've seen in the last week or so, the NASDAQ jump pretty good here. So this is the Qs ETF relative to the S&P 500 overall that was flatter, up a little bit from a week ago, but flatter. Then looking into the Russell 2000 value ETF that's more weighted to financials. Then we look at the broader financial ETF that has obviously a lot of banks in it, right down to the regional bank ETF. So you can see, and it's pretty clear here when you look at it from this perspective, what the cause is, obviously, in financials here. Do all these liquidity measures matter? And it seems like we're not there yet. The uncertainty around, we've got a lifeline, all the banks are putting money as deposits, and then a few hours later, it's, only for a couple of months. So, there's still a lot of uncertainty. I think what that means, from the banking side of things, is that their lending standards tighten even more. So financial conditions are going to tighten from that perspective, maybe doing some of the work for the Fed. So that is something we'll look for them to comment on this week for sure. So KRE, as we commented on BNN Berman's call last week, somewhere below 40, down to 30 is the range where the regional banks make sense. You can trade them all you like short run here, but for value, to me, I'm being a bit more patient before I would look to step in to the KRE. I'm trying to write puts down in the 30 zone over the next 6 months or so. That to me would be an attractive way to play it, conservative way to play it to get some yield. And if it does get down to that lower boundary, i.e. where the banks were trading at, during COVID, I think that would be really attractive. Other than that, there's going to be a lot of noise there. And so, bull bear pick of the week, the bear side, it's just caution from an overall market standpoint. We haven't priced in a full recession yet, certainly not by way of earnings. And so caution overall as the message on the bear side. And where do you look for value? I think natural gas is really attractive here. Oil prices have come down below $70 a barrel. Natural gas, to me, is a transition fuel that's going to be a big part of greening the world going forward. Pure gas play in the U.S., Southwest Energy. We had been writing puts at 5 to buy this name. We bought some today on the option expiry. It's really attractive here from a risk rewards perspective over the last couple of years. If you believe natural gas is going to be a big player in a rebalancing of the world supply chain, where North America and the U.S. have massive natural gas reserves, and through LNG, shipping it off to Europe. So I think there's a great play here. Really, really attractive risk reward. That's it. Again, have a great St. Patrick's Day. Cheers to everybody. And before I forgot, Berman's call, a new time on Mondays going forward, from 3 to 3:30, thanks to a programming change once again at BNN. So look for me Mondays at 3 to 3:30 with Jacqueline Hansen. Looking forward to taking your questions.